Hi everyone, and welcome to week 2 of the InvestSMART Bootcamp. And this week we're covering off module 3, which is different investment vehicles. I'm Tom Wilson. I'm one of the product specialists here at InvestSMART, and I also look after the bootcamp. So if you have any questions, you can definitely contact myself about this. But let's get started. So as always, there's a disclaimer. Basically, we don't give any personal financial advice. It's all general only. So definitely take that into account with any information you see in here. I'll just point out that we do regular other webinars with Evan Lucas and other guests as well. Evan Lucas is the Chief Market Strategist at InvestSMART, and he and I did a From the Bunker themed webinar series when we first went into lockdown in Melbourne, because we're both based in Melbourne. And it gave us a really good opportunity to talk about how COVID affected or is affecting markets in terms of share markets, ETFs, properties, different things like that. We even had a guest presenter, Nathan Bell from Intelligent Investor, come on and talk about the banking stocks. So this week, which is actually tomorrow, we're looking at investor psychology type themed, because you've wrapped them up inside the bootcamp. So you don't have to be a boot camper to be able to take part, but it is more in line with what you're going through at the moment in terms of what you're learning. This particular one is focused on investor psychology, as I mentioned, which is module 5, but we'll always upload them and save them there. So this is only module 3 today or this week. But you can always watch it live, or you could watch it when you get up to that module. You can register for this webinar coming up tomorrow from within the bootcamp, but it's also on the events page on the InvestSMART website. We try to talk a bit more about content in the bootcamp and also outside as well. So Evan and I, we both worked together at a previous broker, and we have a lot of experience in terms of particularly hearing from clients trying to get to grips with the psychology of their trading or their investing. So this webinar, let's focus back on that. This webinar is pretty much designed to cover any questions as you go through the bootcamp material. We don't give any financial advice, and we do need to stick to the course content. So if we do get questions that are perhaps for a different module, I'll either try and cover it off very quickly or basically, or I might refer you back to that week and the recorded webinar for that week as well. We always put up the most recent webinars so you can access them and not have to wait for the live session, but you can always ask us questions outside of the webinars as well. So in saying that, on the right-hand side, you'll probably see the questions button or area. You can actually type in a question and I'll look at it and hopefully answer it for you during this webinar. If not, if it's a bit too complicated, or maybe it even is a bit too personal in terms of asking for financial advice, I'll either try to reword it in a general way or get back to you after the webinar as well. So we also want to make sure that you're using the most of the available resources, which means Intelligent Investor and Eureka Report. You do get 1 month's complimentary access while using Bootcamp. There's so much information on there that even I still come across stuff which I'm amazed or I learn from every day. And just remember, this is an introductory course and it'll cover the basics. It's not like a first-year university course or anything as complicated as that. We won't be jumping into ratios or equations like, how to price bonds, for example, or options. So let's have a look at week 1. We last week went through, I guess, the basics of what we need to do when it comes to investment planning. We need to have a goal, which in my example, I said that I was saving for a house deposit. And we needed to know the time frame. So in my case, I've given myself 3 years to achieve that. So straight away, we've got a reason for doing it, and we've also got a time frame that we can, measure ourselves and tie ourselves into. In terms of risk, I I don't mind taking risk, but I also don't want to go backwards. So 3 years is a fairly short time in the investment world. I'm going to pretty much choose something that's fairly conservative, somewhat defensive, and not really get too risky where I'm going to lose money and actually end up with less for my house deposit. And that would be a disaster. So in terms of how we do that, well, we look at diversification. So diversification is about spreading that risk, and you're going to spread it across different investment vehicles or different kinds of assets. And then what does that actually mean? So asset allocation, how do we determine what is the percentage to each area? And as we looked previously, it depends on the risk weighting of each kind of asset. In terms of stocks are always more inherently risky. So if you are wanting a bit more of a higher return and therefore higher risk approach, you'd have a high percentage of your cash towards those kind of assets. So module 3, that's different investment vehicles. And it's a fancy way of just saying, what can you invest in, or what are the different types of things that you could invest in? We look at, in the bootcamp, shares and ETFs. These are fairly similar in terms of they both trade on exchanges, and there's pricing that's available. We look at managed funds and portfolios as well. And we also look at the more defensive type approach of cash and bonds. So shares is something that a lot of people know about. They might get caught up on some of the finer details in terms of how they work, or what the costs are, or any kind of risks involved. First and foremost, you profit from them either going up in value, so that's called like a capital appreciation or capital growth, and they also pay out income. They pay out dividends, which is essentially, as you're a part owner of the company, you're getting a share of any kind of profit that they make, and that gets paid back. But not all of the shares pay a dividend. Some may retain those earnings and decide to reinvest them back into the company itself. It's fairly interesting. In Australia, we tend to have a lot of companies that do pay dividends, whereas in the US, you tend to see a lot that will retain their earnings and actually put them towards capital projects, or building more production facilities, or even reinvesting into research. And it's quite interesting. Nathan Bell and I had a webinar, I think it was earlier this year, and was talking about the banks, about he feels that it's good that they pay out the dividends, because they're probably they've made some really bad decisions in the past with how they've gone about reinvesting those earnings and not paying them out, such as buying other banks overseas or investing in other businesses that just haven't done well. It comes down. It's an interesting debate, and it comes down to a lot of personal preference. But in Australia, a lot of us like to receive our dividends and our franking credits that go with it as well. So one thing to remember with shares, you'll need a broker to be able to trade them. So that's a company like CommSec, NabTrade. There are a lot of smaller players out there as well. Just always be sure about the fees involved when it comes to trading. So obviously there's brokerage you'll pay, but there's also other fees such as subscription costs or holding costs. Some of the cheaper players, they might charge you as little as $8 a share to buy and sell Aussie shares. But if you're not doing it frequently, they see you as a cost, and they'll actually charge you a subscription fee, which may be $50 for 3 months. And that just helps to cover their costs as well. So remember, with trading or buying shares or share trading, you have to pay brokerage when you buy it. So that's, in a sense, a cost to get into that share, but also on the way out. So when you buy and sell, you'll pay brokerage each time. So a lot of people tend to forget that. They think that they just pay brokerage once, or they may think they don't have to pay brokerage at all. And there are some companies out there that are starting to offer free brokerage, particularly for international shares. There's different ways that you can use share trading or share investing, but we cover off value investing and we look at growth investing as well. The other ones may be, there's a lot of people that do day trading, and that can pretty much get quite expensive quickly because you're jumping in and out of shares over a period of a day or a few days, and each time the broker is taking their share, taking a clip from your profits. So we've got a few tools that we can look at. Intelligent Investor is one of the best ones. They offer share recommendations. They've got research. They even have model portfolios. They used to have a question and answer section, which unfortunately has been retired, but you can actually now ask them questions directly through their articles. And I'll briefly show you that. I'll jump on and go through it. So if I'm on the InvestSMART webpage, I can go to the top here and click Intelligent Investor, and it will take me to the Intelligent Investor page. And I can see recommendations at the top and research, but I can also scroll down and I've got some of the latest recommendations here on the side. I can click See All if I want to go and see every single one. I'll right-click on this recommendation types because this is always something we get asked about quite a lot. And it's how to understand what each recommendation means. Like, what does speculative buy mean? Is that risky, or is that something that I should be getting into? And this will explain it here as well. So if I go back to the recommendations, and you can see here that they're updated quite frequently, even as of today, and then yesterday as well. And each of the analysts, if you click on it, they've written an article as to why they believe that this is a particular recommendation. So Gurav wrote this one yesterday, and you can see they go into quite a lot of detail, which is something I just find fantastic myself. Like I love finding out about a company, its background, who its competitors are, what its advantages are competitively as well, but also it looks at their assets here. Like, he's breaking down all their holdings, and this is information that you could do this yourself. You could sit there and go through all of their documentation, try and find it yourself. But if you've got someone who does this for a job, it's almost like a no-brainer if you're going to be someone who's actively buying and selling shares. So they've got the recommendation on the right-hand side here. If we look at the research, that was a good example there. But they also have, let's go back to the main page. They also do podcasts and videos and special reports as well. The education section is quite helpful. There's a lot of information in there that talks about value investing in particular. In fact, if we go up to recommendations, value investing, there's a complete article talking about how they do it, what they look for in stocks and how it works. They also have model portfolios. So you'll see there's the income portfolio, the growth, and the ethical. If we have a look at the growth portfolio, this will show us all the shares that they have in their portfolio that's geared towards growth in shares. So it has a breakdown, and then it also shows companies like Audinate, Class, and goes right through it. It'll show you as well the different weighting in which it should make up your portfolio. So this is just a recommendation, but what they're saying here is that if you've got a portfolio set aside for active shares or growth shares, you would want to try and keep it within around this percentage here and not let too much of it take up that portfolio itself. We'll come back to the Intelligent Investor in a little bit. Eureka Report, which is headed up by Alan Kohler, is also quite helpful for shares because he'll go and interview all the different CEOs of share companies, the founders, people doing startups. He also talks a lot about educational information and strategies as well. Particularly, there's a lot of his experts like Liz Moran talking about bonds, Evan Lucas, who we'll do the webinar with tomorrow. It's very helpful. Stephen Mayne as well, who's well known for his, I guess, standing up to a lot of the leaders of companies at board meetings and I guess pushing them to answer the tough questions. And he writes for us as well. So I'll just check if there's any questions as we're going. Feel free. There's none here yet. We do have some that were given to us before the actual webinar, which you can always do. You can always actually enter in a question that you'd want me to cover off as we go through. And if you can't make it, we'll actually upload the webinar at the end and you can review it then. There's a question here from Orpha, and it's relating to shares. And they're talking about, can you please explain the answer to this question on the quiz in the bootcamp? Over time, you should aim to own blank stocks for diversification. So basically, it's asking you ultimately or eventually, how many stocks or shares should you look to own? Now, in the section on shares in the module, it does actually give you an idea, a rough number or a range of how many you should own. And it comes back to diversification, which is what we looked at last week, where you don't want to just go out and buy one share. I think we'd all agree that if you owned one share like Commonwealth Bank, you would be heavily exposed to Commonwealth Bank. So if they had some kind of catastrophe happen specifically at their bank, you're going to have, if you've got your whole portfolio who invested in that one share, your portfolio is going to have a catastrophic event as well. If you then decided that you'd buy NAB, well, you're not diversified. You're basically then solely in two shares, of which are banking shares in Australia. So if something happens to the banking industry, you'll be affected heavily. If you were to diversify a bit more, say buy something like Telstra or even start to spread outside of those, you're becoming more and more diverse. You should aim for anywhere from around 10 to 20 as a goal, and that will try and help you to start to get more spread or diversified, spreading your risk. The thing is, if you're starting off with a smaller amount of cash, just remember that it can be hard to try and diversify because you're paying brokerage each time you buy one of those shares. And if you've only got, say, $1,000 or $2,000, you're going to have a very small amount in each of those companies, and the brokerage would have chewed up a quite big chunk of it. So in that case, you might want to look at something like an ETF, one that gives you exposure to that particular market, which might take us to our next section, ETFs. I'll just go back because I think I got excited and skipped. Oh no, okay. Okay, so ETFs. You've probably seen in the bootcamp that ETF stands for Exchange Traded Fund. So it's basically a fund that just trades on an exchange like the ASX. There's so many different types that you can choose from. There are some that are actively managed, some that are passively just tracking indices or tracking an index. There's a question here from Sophie that we received before the webinar, and she's asking, are ETFs equity focused or do they invest in cash/bonds as well? Yeah, they definitely do focus on all of those different asset types. So you can have ETFs that are just focused towards equities, such as shares. In particular, there's a lot that we use at InvestSMART to get exposure to certain markets or certain asset types, including cash and bonds. And I can, in a second, just jump in. I'll show you exactly what I mean in terms of what we use to give us exposure or to give us access to those markets at an affordable price. You can also look at sector or industry ETFs. So if you just want to get exposure to, say, one area like IT in Australia, you could actually go out and buy an ETF that has a number of different IT-related type holdings. And if you bought that, it would give you access to that particular market. There's international ETFs such as international shares or bonds, commodity ETFs, factor ETFs. They're a bit more actively managed and a bit riskier. There's some really interesting ones. A company that's an Australian company called Better Shares, they offer a robotics industry type ETF where if you are someone who is quite keen to have part of your portfolio exposed to the robotics industry, then they got an ETF for you. There's heaps of others out there as well, such as ethical type ones, ones that might focus solely on renewable energies. They're really quite fascinating. And I won't let you down. I'll show you how you can actually have a look at all different types in a sec. But basically, to give you a quick idea, if we looked at wanting to get exposure to the ASX 200, so that's the top 200 Aussie shares by their size in terms of share price times number of shares, that gives you their capital value. I could either go out and buy those 200 shares individually, which is fine. And I'd have to do it on a percentage because they're all different percentages within that index. So I could go and buy a certain percentage of BHP, Commonwealth Bank, Flight Centre, etc. I would pay a fortune in brokerage because I would be paying it each time I'm buying it. And even as time goes by, if there's any fluctuations in terms of share prices or the sizes of those companies, you may have to readjust and sell out of some of them, and then also incur brokerage, but also spend your time that you could be doing something else with in terms of keeping an eye on what kind of percentages they're making up. But an ETF is essentially a bag, or I like to call it, it wraps up all those shares and then offers it as one product that you can buy. You still get paid dividends, which they call distributions. So it does have a lot of benefits. I might come back to the growth fund because that's a really good example. And I'll just show you what I'm talking about. So with InvestSMART, we have, and again, I'll probably talk about what we actually do in terms of investments, but there's a section here called diversified portfolios. And what we do is we offer capped fee investments that spread you across different asset classes, depending on your time frame and what kind of risk that you wanted to take. So for example, let's just have a look at conservative. And this is by no means a recommendation. I'm just using our products here because I am aware of them and I know much more about them than say others. So what we do is we're saying here in a conservative portfolio, because it's going to be quite defensive, conservative, you're going to put a big chunk, 46% towards fixed interest, 20% towards cash, 12 to international shares, 11 to Australian shares, and just under 10% to property and infrastructure. So how do we do this? Do we go out and then, do you want someone at InvestSMART buying all the shares that they think are probably best to get you access to those markets or to those assets? Or the thing is, well, if you're wanting someone to do that, stand there and make individual decisions, it's called an active fund, someone who's actively trying to outperform the market. These don't do that. These passively follow the market itself. So we're happy to accept the market return. We're not trying to outperform. So you'll get the same return as what the market provides, less any fees. And history tells us that this is a good approach. In fact, even Warren Buffett, he used to say, I think he's sort of updated his advice, which I need to check, but he often used to say if he passed away, he'd tell his wife just to put it into an index fund which tracked the index. So you're not trying to beat it, you're just wanting to get the returns. And that would have proven to be a pretty good strategy if he had died a while ago, but he's still kicking on, obviously, which is good for him. Good for all of us and the shareholders too, can't forget that. But let's have a look down and say, okay, we go to key facts allocation. How do we at InvestSMART get exposure to these different asset types? And on the right-hand side, we literally show you the holdings that we invest in. So as Sophie was asking, can ETFs invest in cash or interest type focused assets? Yes, they can. Better Shares, for example, offers a Australian high interest cash ETF. And as I said, it trades on an exchange. So it trades on the ASX. So there's a buy and sell price and uses the ticker code AAA. There's also a bond ETF that UBS offers here with the ticker code IAF. And then you've got different ones here, such as an infrastructure type ETF, which is hedged. So it's already taking into account the currency fluctuations. And in the last webinar, I did talk about how someone asked a question about whether you need to hedge for currency, which I then referred back to a previous webinar where Evan Lucas and I were talking about this specifically, and that often the fluctuations, if you're trying to hedge it, it can be quite complex and can be more expensive than actually just having it unhedged or not trying to anticipate currency moves. But in this case, like this one is offering it as hedged automatically. They usually charge a bit of a higher fee for this. So you need to compare whether or not it's in your best interests. So this is the next one here is the BlackRock iShares Australia 200. So this is the one I was using as an example in that slide. It's basically got the 200 Aussie shares wrapped up in an ETF, and it charges us a low fee for BlackRock to manage that on our behalf. They take care of all the buying and selling of shares that are in that index, and they also take care of any kind of distributions that are paid or dividends, and they'll pay them back to us. There's others here, such as a bond index, international shares that not just US, but also Asian shares as well, or European shares. And these are the ones that we use. They're different slightly for each different kind of portfolio we offer. The beauty of this kind of product, and I'll touch base on it a little bit further on, is that it's managed. So we do all this for you. You could definitely go out and just buy those ones that we use ourselves, but we keep track of all of the different percentages, do the rebalancing, and also do all the tax reporting behind the scenes as well. We're looking briefly before at the Intelligent Investor Growth Fund. So this is the model portfolio that the analysts sit there and pick and choose. And what they have done is they have offered it as a managed portfolio for about 5 years now. And it's come time, just like its brothers here, the Equity Income and the Ethical Share Fund, it's going to list on the ASX as a tradable security. Now, these two here are already listed. They've got the stock code of INIF and INES. So you could use your broker like CommSec or NabTrade, and you can actually buy and sell them already. But the Intelligent Investor Growth Fund is about to list. So it's in the process of listing. It will close off on the 25th of September. You can apply for units in this fund. They'll list at $2.50 per share on the 5th of October. And you can take up units in this growth fund in a number of different ways. A lot of people go into it as individuals, so as in they just open or apply under their own name in case, for example, that'd be me applying as Tom Wilson and getting my units given to me, which I could transfer to my broker. The other way you could do it is through companies, self-managed super funds, even for children. We've got account setups for children as well. So we get a lot of parents who will open up or purchase units for their child. As it's been running for 5 years as a managed portfolio, luckily we can show how the performance has gone, comparing it to the accumulation index of the S&P 200. So the S&P 200 accumulation index just means that if you were to reinvest all the dividends that the top 200 shares in Australia have paid, they would be an accumulation index. The normal S&P just shows you the actual share price, doesn't take into account the dividends. So it's saying that over the 3-month period, and you can keep going back further, you can see that it has most of the time outperformed that index. So that's important because that index is something where you could just plonk your money into, sit back and not have to do anything. It would be passively getting the return that that index or that market is providing. But with the actively managed, you've got that team here led by Nathan Bell, and they're out there picking and choosing what they think should be in this fund. So that's been quite busy. So we're trying to raise $100 million. We're on track for that, and it'll list. It's definitely reached the minimum, so it will be listing, and that will take place on the 5th of October. So I'll just check if there's any questions. There's none on the live webinar yet. We've got a couple still on there before the webinar that have been submitted. But with ETFs, just remember again, unless it's an initial offering like that growth fund is, you'll need a broker to be able to trade it. And it's same like shares. You'll pay brokerage to buy them. You'll pay brokerage to sell them. There's different types that we went through before, and you'll also get distributions, which are like dividends, paid out to you as well. So there's a lot of tools. We went through the IIGF. That's the ticker code that you can buy that eventually after the 5th of October. You can buy it on the ASX. Eureka Report has really good tools to filter all the different types of ETFs. So I had a client ring up just the other day actually, and he was talking about wanting to hop into the growth fund. So he's put his application in and he'll be issued some units in that when it launches. But he has a specific investment strategy where, and we'll talk about this in a future webinar, but you can also jump ahead to investment strategies, that module on Bootcamp. And what he has is a kind of core and satellite approach. So he has like a passive investment strategy at the core where he will invest in, say, those InvestSMART diversified capped fee portfolios. And that's just tracking the market, not trying to outperform. So it's like a slow and steady. He knows his risk with that. But then on his satellite type approach, on the outer, he's got little groupings of actively managed investments. So he has one where he has different stocks recommended by Intelligent Investor, and he'll go out through his broker and purchase them. And that's one tiny percentage of his overall portfolio. The other is that he's going to invest in the IIGF, and that will be another little active part. But then he's also got another part there too, which he wants to get more exposure to, I guess, ETFs overall. So some that give him exposure to certain parts of the market. Now, I was telling him about the exchange traded funds filter tool here on the Eureka Report website, and click on it. And what it does, it gives you the opportunity then, and you could spend hours doing this. It's a bit of fun if you're into it. You can actually search by all the different types of ETFs that look at different asset types. So as Sophie was asking before, she was asking about fixed income and cash ETFs. Just based on that, I could say find ETFs, and it's going to have heaps. Like there's the AAA, what we were talking about before. So it's got a 5-star rating from the InvestSMART rating, and that's basically looking at how big it is, what the kind of fees are as a percentage of the funds under management, how liquid it is. Can we buy and sell it easy, or are we going to get stuck in it if we bought it? The spread, the difference between the buy and the sell price, and how close with its tracking error, how close does it actually follow the benchmark? So that's a really handy little thing. Not all of them are rated. BetterShares AAA obviously is, because we use it ourselves. And I can open it and go straight to the Eureka Report page where they might have some related articles here. I can go to the BetterShares website, find out some more information about it as well. And it gives me some information underneath. So this is just one example. It's not a recommendation from me whatsoever, but it's definitely something that you could spend a long time researching if you needed exposure to certain areas within your portfolio. Go back to the Q&A is quite handy. That's the Ask Alan. So you can actually submit and look at some of the older questions, or you can actually pop in your question here and get Alan to answer it. He gets a lot, obviously, so he can't always answer every single one. But when he does, it's worth it. So you've got access to that for the month unless you're a subscriber already. So definitely take advantage. So a managed fund, I know it explains it in the bootcamp, but the best way to look at it is that it's a pool of investors and they all get their cash together and they put it into like a fund where there's a manager who chooses what to invest in, what not to invest in. You have a small piece of that, and they're usually charged unit prices. So you know what you're going in at, and to get out, you sell it at a unit price as well. There's different types. There's ones that are will act as listed investment companies like Berkshire Hathaway, Warren Buffett's company, for example. There's also unlisted, so ones that don't trade on exchanges. You've got to be careful sometimes of the fees that can be charged. Sometimes they'll just charge an open percentage fee, which can add up. So they'll just charge that on top of all of your investments in terms of the size of which you invested. They'll apply that percentage. Eureka Report has interviews with different managed fund managers or CEOs. They've got the filters there as well, where we can also not only search for the ETFs, but we can actually search for managed funds and listed investment companies, LICs. And that works in the same way that the ETF filter does as well. So managed portfolios, they might sound the same to managed funds, but they're a bit different. Think of it as you have your own investment portfolio. So you've opened up an account with NabTrade and you've bought a number of different shares, maybe even some international shares. It's a similar concept, but instead of you having to make the day-to-day decisions, sitting there monitoring, rebalancing, sorting out your tax reporting, you get someone else to do it for you. So you get a manager. There's different types. There's active, so someone who's actively behind the scenes, picking and choosing what goes in there on a daily basis, for example, just like the intelligent investor type approach. Or there's the passive approach where, like the InvestSMART way of those portfolios I showed you before, we're just tracking the market itself and we're happy to receive that market return. We're not going to try and beat it and get too risky and charge you high fees. We'll cap the fees and also just receive what the market is giving. Leads us to the next point. Beware of uncapped fees that can be charged. Most actively managed funds will charge you uncapped fees because there's a lot of cost involved, a lot of human decision making behind the scenes. The intelligent investor, they're an open percentage for the managed portfolios, and that will apply to the size of your account. But just remember, they're always trying, the active managers are trying to outperform, so get better than what the actual market is returning. Some of them will even charge you performance fees as well. So if they do beat whatever benchmark that they've either decided to choose, so that's another thing you'd be careful of. Just make sure that they're choosing an industry benchmark, one that the whole industry is trying to beat, as opposed to there are some fund managers or managed portfolio managers who will choose something like, let's beat the RBA overnight rate. And that's so low at the moment that nearly anyone could try and do that. And then they get paid a high fee. So here's just an example we showed you before. The InvestSMART has passively managed portfolios, and Intelligent Investor has actively managed portfolios. Now, the only caveat with this is that we're actually stopping on the Intelligent Investor. We're not going to be offering the managed portfolios going forward. They're still available for existing clients invested in them. But like I was showing you before, we've decided to list these on the ASX. And that makes it a little bit easier in terms of the actively managed ones, because it makes it cheaper for clients. They just pay one fee, and it makes it easier for us at our end as well. So cash and bonds. And we do have a question from Philip before we go into this, and he did put this in before the webinar started. And he says, Do you have any review recommendations or advice on different government bonds or just bonds in general? Well, there are some resources we've got, which I'll definitely touch base. But when we talk about cash and bonds in the bootcamp, we're talking about risk-free, which means there's no risk that your capital is not going to get returned to you. Now, there's always a risk. Some scholars out there actually can go further and say that there is no such thing as risk-free. There's always a risk involved. And there is. With bonds, for example, you do have things like interest rate risk as well. Bonds, when you buy them at a face value. So say it'll be $100 and you'll stump up $100 to buy it, and it says that over a period of time, some of them go out very long, particularly government bonds, like 30 years, they'll say, we'll pay you 5% per year. Now, at the time you're buying that, the interest rates available might be around about 5% anyway, or 4%. So when it does start to trade after you've bought it, depending on what happens with interest rates in general in the market, if you are the holder of a bond that's paying a certain interest rate, you'll find that the face value of that bond as it's trading will fluctuate. So it'll go either up or down. And it's a really interesting concept, because if you were to then sell that bond that you hold right there and then, you could have a capital loss. So you might sell it for less than you bought it, or you might sell it for more than what you paid for it. The risk-free part just means that after 30 years, when it comes time for it to be redeemed, you'll get that $100 back. So even if it's traded throughout the market, its 30-year lifetime, and it got as low as $2, then what should happen is that the government bond, for example, would turn around at the end of that 30 years and they would give you that $100 back. Now, there's a lot of ifs and buts, but governments tend to be very creditworthy, and the risk of them not giving you back that money is very low. So that's when we talk about with risk-free. In terms of the term deposits and savings accounts, we're talking about schemes where the government has also backed those as well. Now, Philip asked about the research or recommendations, and in Bootcamp, I do point to this as well, but it's a resource that you'd be crazy not to take advantage of, because she explains it just so well. I'm talking about one of the experts here, and that's Liz Moran. So Elizabeth Moran, she actually works in this industry and has so much background to it. And here she's talking about government bonds that she only just recently wrote about 3 weeks ago, talking about trying to find the best deposit rates from different savings or term deposit accounts. This is where I would point you, Philip. This is the kind of area where, if you're wanting recommendations or reviews or even advice on different bonds, whether they be government or commercial, check out all the content by Elizabeth Moran, because it's going to be the best place, or one of the best places, to find a lot of this information. She even has talking about hedging your portfolio that you've already got with bonds, and she does this over 3 parts: investing in ETFs. There's so much information here that, here's risk-free investment returns as well. So, I mean, if you always want advice or recommendations, you can always think about seeing a financial advisor or a planner as well. You do have this information available to you as part of your bootcamp access. You get 1 month free. After that, there's certain deals that you can get from us as well. So I think I just ran through those tools anyway. InvestSMART itself has a term deposit search. So if you do want to look up different term deposits, you can go to the InvestSMART website and go to tools, and there's a term deposit section there as well. So that brings us to the end of this webinar, which is fantastic. It's just flown by. If you've got questions, you can always email us at bootcamp@investsmart.com.au. or you could use the online chat, which is on the InvestSMART website. Feel free to reach out with any feedback that you've got. If you've got questions for the next webinar, definitely enter that in as you're registering for that. And you can find them all in the bootcamp modules themselves. There's also the webinar tomorrow morning that we'll hold with Evan Lucas, and that'll cover off trading psychology. So definitely try and make that one. If you can't, just register, or you can watch it in the future inside the bootcamp or on the InvestSMART website. But apart from that, have a lovely day and best of luck, and I'll talk to you soon.